The Dow and the S&P 500 falling ahead of President Donald Trump's highly anticipated news conference on China. For some market views, we turn to Jim Cahn. He's Chief Investment Officer at Wealth Enhancement Group, joining us from Minneapolis. Welcome, Jim. Now,
Thank you.
the markets have mostly been shrugging off news on China of late, focusing instead on the vaccine and hopes for an economic recovery as the economy reopens. But will the tighter security controls that China plans to impose on Hong Kong and possibly President Trump's reaction be a bigger issue for investors now?
It's sort of hard to remember sort of the days before the coronavirus was sort of everything that was covered. But trade between the United States and China was actually one of the key things that was moving the market. And so over the last 25 years or so, the integration of our economy with the Chinese economy, the opening up of that billion-plus people market has really driven wealth on both sides of the Pacific. It's been one of the primary reasons for the recent period of prosperity. It might not feel like prosperity, but it really has one of those prosperous times in history. And I think that what we're seeing is the rise of potentially a new Cold War. China is beginning to assert itself more aggressively, both militarily, also sort of in the political sphere, especially in Southeast Asia and in the South China Sea. And we have sort of a president of the United States who wants to equally assert himself and equally assert his dominance. And that just hasn't played well. And so what we saw is the Chinese asserting their sovereignty rights over Hong Kong, something that they said they would not do when the British handed Hong Kong back to China. And the U.S. is going to respond. Now, it's not unprovoked. Some of the U.S. actions are probably why the Chinese took such actions in Hong Kong. And namely, the United States has been pushing towards a more independent Taiwan. They've been starting to invite Taiwan to participate on the global stage. And that is basically poking the bear. China, bugaboo, their biggest issue in the United States is our support for Taiwan, and it's likely a tit-for-tat game around that diplomacy.
So Jim, you mentioned possibly a new Cold War. What would that mean for the markets in the midst of COVID-19 in an election year?
Well, I think that it's unfortunately, leaders tend to do well when in the short term when they can foment fear and anger towards someone other than themselves when things aren't going well. And so I think there's an element of that in terms of an election coming up and being able to point to China, especially from U.S. politicians, as a source of a lot of the issues that we're having in this country, namely the double-digit unemployment. I think that longer term, though, it's quite dangerous for the world. And it's not dangerous in the way that the Cold War was dangerous. It's unlikely that this is a Cold War that will turn hot. We're not going to point nukes at each other. But it is likely dangerous in the sense that a lot of the prosperity we've had by sort of leveraging and integrating supply chains, integrating markets, that's going to come undone. And if that comes undone and we have competing economic spheres of influence between the United States and China, that's really not to anyone's benefit.
How should investors play it?
It's very difficult. There's not, no one really has a very good track record of predicting these geopolitical trends quite well. And I think in the short term, the way the vaccine develops is much more relevant than the way that sort of the U.S. China relationship develops. I read an article the other day that all stocks now are vaccine stocks, right? All stocks are really med tech because it's really sort of, the stock market's movement is really predicated on how we keep this vaccine in check. But I think longer term, if you're looking at, companies in the United States that are in the manufacturing sector, companies that rely on sort of low-cost labor in China, I think those companies will be hurt to a degree. And it's not to say you stay away from them. It's just to say that that's something that you monitor as you sort of think about their future.
And Jim, should investors bet on stocks that'll do well in a stay-at-home economy or those as the economies reopen?
Trying to make short-term predictions on the stock market is really a fool's game, and I think that anyone who's tried that has learned that at some point in their career or their investing life. I think that you need to have a well-balanced portfolio, and certainly what we've seen, at least with the S&P 500, is that there are 5 stocks that now make up 20% of the S&P 500, and they're all big tech names. They're doing very well in the stay-at-home economy. That's as much concentration as we've had. If you look all the way back to the 1960s, that's dangerous. Then if you look at the banks, if you look at value stocks that have performed terribly, not for the last year, but really for the last decade, in particular the last 5 years, they're really options on a quick recovery. So if we look at banks, right, banks will suffer with default rates pick up. Banks suffer when the yield curve is flat. If we see defaults below what we expect them to see, if we see the yield curve continue to steepen, banks are going to be a great place to invest. Same with small cap stocks. Small cap stocks have much thinner margins than large cap stocks. So if you have a prolonged period of shutdown, it's much more likely that you'll see defaults in small cap companies unable to finance themselves without additional dilution. And so as we think about these areas of the market that aren't the big 5 names that are driving the S&P, they're really sort of options on a quick recovery. And you want to have something in your portfolio, but you may not want to bet, you may not want to bet your entire future savings or your entire pool of capital on a quick recovery in the value sector.
All right. Okay. We shall have to leave it there. Thanks a lot, Jim, for sharing your thoughts on China and the opening of our economies. Our thanks to Jim Cahn, CIO at Wealth Enhancement Group, coming to us from Minneapolis. I'm Fred Katayama, and this is Reuters.